year's retained earnings balance. And then sometimes, I don't like to see it actually, but sometimes you might see an other or some plug or balancing figure. My opinion is that when you model, you shouldn't need to plug. You shouldn't need to have a balancing figure in your model just so your balance sheet balances. And the way we teach you to do it in class here, you shouldn't need to have that. Right? That'll make sense when we actually get into the modeling a little more. But plugs are just generally something that I don't like to see. And then finally, the cash flow. Right? All changes in our balance sheet accounts need to be run through the cash flow. And that should have become a little evident last night in doing the homework for the DCF. You started to see how accounts receivable growth was a use of cash, paying down payables was a use of cash, selling inventory would be a source of cash, those types of things. Those changes tell us what's happening with our cash flow, or at least what's happening with our cash flow in some respects. They need to get run through the cash flow statement. And just like we talked about in class 1, operating cash, we take net income, we add depreciation and amortization because they're non-cash items. And then we add or subtract any changes in our working capital. And then any other non-cash expenses that are in our income statement. Non-cash gains, non-cash losses, etc. Investing activities, basically our CapEx, any sales of assets, purchases or sales of long-term investments, those types of things. Cash from financing, really going to be related to our debt schedule. Changes in our debt, changes in our equity accounts, any dividends that have been paid out, those types of things. And again, ending cash is simply equal to beginning cash plus our change in cash for the year. And our change in cash for the year is just the sum of cash from operations, cash from investing, cash from financing. And then finally, the debt schedule is something else that we put together. And again, this is really geared toward analyzing each piece of debt individually, calculating how much interest expense and or potentially how much principal is being paid down on each piece. All right, so each tranche of debt will be looked at separately. They'll typically have separate interest rates associated with them. Our debt schedule is going to allow us to calculate how much interest is going to be paid on each. Okay. The one component of our debt schedule that I want to talk a little bit more about, though, is a revolver. Okay. The company, if it needs cash, we assume that it's going to have some revolving credit facility in place. It can go borrow from that. When it has excess cash, it's going to pay down its revolver. Okay, just like you or I might use a credit card, I think that's a good way to think of it. But the one thing I want to talk about now is how these financial statements, how the income statement, how the balance sheet, how the cash flow statements relate to one another. And I want to start talking about the integrated nature of these statements, and when we say integrated cash flow model, I want people to understand what I mean by that. All right, so if we take our income statement, just like we've seen several times already, revenues less cost of goods sold gives us gross profit less SG&A gives us EBIT less interest gives us pre-tax or earnings before tax less taxes gives us net income. Okay, actually I want to do these in reverse order. Okay, well, where do we see then net income? Where does net income goes? As we just talked about a moment ago, it's the first line item on our cash flow statement. In our cash from operations section, we're reconciling net income to be on a cash basis. So we've got net income plus our D&A plus or minus any change in working capital. Okay, and we sum those up. That's our cash from operations. Our cash from investing, we've got CapEx. Okay, any dispositions to the extent the company has them. Cash from investing. And then our financing section will be changes in our debt accounts, changes in our equity accounts, less dividends, cash from financing. And if we add the three of these up, it gives us our change in cash for the year, right? And if we add these three together, we get our change in cash for the year. If we add that to beginning cash, we get our ending cash. Okay, well, where do we see ending cash? That goes right back to the balance sheet, right? It's the first line item on our balance sheet. It's cash, got AR, inventory, etc. Those are our current assets. Got gross PP&E, less accumulated depreciation, net PP&E. We've got goodwill, etc. We've got total assets. All right, I'm abbreviating. Okay, a lot of these individual accounts aren't that important for this example. And then on the liability side, AP, accrued liabilities, etc. Maybe current portion of long-term debt, revolver borrowings, short-term borrowings, or maybe revolver borrowings might be longer term. Really depends. All right, so you got our current liabilities. We've got our long-term debt, maybe including those notes payable. And then we've got our shareholders' equity accounts, retained earnings, common stock, etc. And I am just abbreviating here. And then total liabilities and shareholders' equity obviously have to equal total assets. All right, so that's kind of a rough outline of how the statements work together. Right? But what happens when come through our income statement, maybe the company's losing some money, roll through our cash flow statement, maybe at the end we add up our cash flow statement, we add up all our changes in cash, and it shows that the company has negative cash at the end of the year. And typically you can't really have negative cash. Okay, what is negative cash? It means the company needs to do what? They need to borrow, probably. They need to get some capital to at least bring their cash position to zero. And typically what we do in that situation is if they've got a revolver, they're going to borrow. That is, their revolver balance is going to go up, at least to the point where we can get ending cash to a zero balance level. Right, well, what happens if a company borrows? Anytime we borrow, anytime we take out more debt, we have more interest. So interest expense goes up. All right, what happens when interest goes up? Earnings go down. Earnings go down, we need more cash. We need more cash, we look to our revolver, we borrow more debt. We borrow more debt, we have more interest. Everybody see the cycle there? That's what we mean when we say an integrated cash flow statement, or an integrated projection model. This is basically what we're building. Okay, this is what we're going to be building today. And the way we determine the amount of debt that the company needs is through that debt schedule. So that debt schedule, specifically the schedule where we figure out our revolver borrowings or repayments, ends up being the glue or the keystone to our model, in that it tells us how much cash we need to borrow or how much cash we have available to repay excess borrowings. Or maybe how much excess cash we have just to put right back on our balance sheet. Okay, if a company has no debt and they're just generating a lot of cash, they're not paying down debt, they're just keeping it on their balance sheet. All right, so this is basically what the exercise is going to be today. This is how these all relate to each other. And when we set up Excel in a certain way, Excel has the capability to basically solve this circular loop that we just explained. Let's, at this point, rather than going through this last section of the slides, what I want to do is build the model. A couple things before we get into it. The model, or the file, has 3 different tabs. The first tab is an instructions tab, which should mimic the hard copy handout I gave you. All right, so I gave you this in hard copy form, really so you're not having to flip back and forth between the tabs to see what your assumptions are. All right, the second tab is an assumptions tab. It also contains those historical ratios that we talked about a moment ago in the lecture slides. This is where we're showing what the company has done historically in terms of their revenue growth, in terms of their profitability, in terms of their balance sheet items, how quickly have they collected their receivables, turned their inventory, etc. We're also going to have some interest rate assumptions here. So what is the company going to be paying on its debt? And then also, how much is the company going to be amortizing each year on its debt? When I say amortizing as it relates to debt, I mean how much are they paying down in principal? All right. Sometimes pieces of debt will have not only the requirement to pay interest, but they'll also require the company to pay principal as well. Think of like a mortgage or a car loan that we might take out. When you make that monthly payment, usually it includes some interest, it also includes some principal. And a lot of times the same thing will hold when we talk about longer term pieces of debt like term loans, that type of thing. And then the third tab of our model, the actual model tab, this is where, as we talked about earlier, on the left side we've got historical financials of the company for the last 5 years. And you'll see that each year of our historical period has an A after it, A being for actual. All right, so we put these in really to give the reader a perspective. What has the company done historically? And then allowing them to see or to contrast that with what we're projecting. And then at the end of the day, does it make sense? Do these projections make sense based on what the company's done historically? We've also got all of our financial statements on one page or on one tab. We've got our income statement, we've got our balance sheet, we've got our cash flow, and our debt schedule. And it's generally recommended to set up your model this way, as opposed to, say, putting an income statement on one tab, a balance sheet on another, a cash flow on a third tab, and a debt schedule on a fourth tab. When you're toggling back and forth between tabs, you increase the chances of making an error. And by keeping as much as possible on one tab, you're minimizing that chance. And it's also easy to scroll around and look at the output as well. All right, so that's basically how this file is set up. The first thing we're going to do, we're going to first review the instructions, and then we're going to populate these assumptions, because without the assumptions we can't build our model. We'll populate our assumptions tab, then we'll build our model using these assumptions as drivers. All right, so that's the exercise. Take us probably 2.5, maybe 3 hours to get all the way through this, but at the end of today's class, we'll have a fully working model where if we wanted to go in and say make some changes to the assumptions, say, instead of growing revenues 5%, what would the company look like if we grew them by 20%? We would be able to make that change in one place and have it flow all the way through our model. And that's one of the goals to have a working model, is to be able to sensitize it and make those changes. One thing I mentioned yesterday is, as we go, I'm going to keep a running tab of the keyboard shortcuts that I'm using. When we model in Excel, it is very, very inefficient to use the mouse. Very inefficient to go and find your mouse, scroll up, try and find the icons and click and copy and paste and select ranges. It's much easier to use the keyboard. And the way Excel is set up, there are a lot of unique, helpful keyboard shortcuts that we can use to do things like copy and paste and do those repetitive items and save ourselves a tremendous amount of time. So one of the biggest goals of today's exercise, number one, I want everybody to understand what we're doing, but I want you to get away from using the mouse. All right? Try not to use the mouse at all. Try to use these keyboard shortcuts. Again, I'm going to list them all on the board. I'd recommend that you keep a running list in your notes, something that you can refer back to. We give you, as part of the course materials, we gave you rather, a large, very comprehensive list of keyboard shortcuts. It's a huge list. The ones I'm going to give you today are the ones that I use most often and I think you will use most often. All right, so keep a running list of these. Commit them to memory, and the more practice you get, the more second nature it'll become. All right. You also, if you ever go to work in an investment bank, if you get caught using the mouse, people will give you a hard time about it. All right. You shouldn't really be using a mouse when you model. All right. First thing I want to do though, before we review these assumptions, is I want to make sure Excel is set up properly. All right, I want to make sure we configure Excel in a couple different ways. One, I want Excel to be able to take into account the circular logic that we outlined on the board earlier. Because if we don't set up Excel, you're just going to get a circular reference warning over and over and over. All right, so the first thing I want to do is I want to change some of the global settings on Excel. If you're working in Excel or in Office 2003, it means that you probably do not have this little icon up in the top left corner. Now it's hard to see on the screen. But you don't have that Office button in the top left corner. If you're working in Excel 2007, as I am, you do. All right, so if you're in Excel 2003, what I want you to do is hit Alt-T-O, Alt, Tools, Options, and you're going to get a pop-up box. In that pop-up box, I want you to select the Calculation tab. And then just wait a minute, because I'm going to get the Excel 2007 folks to the same place. If you're in Excel 2007, and here you can use the mouse, I'll let it slide this one time. I want you to click on this icon up in the upper left corner, and I want you to scroll down here as I'm doing and select Excel Options. Click on that. You'll also get a pop-up. And I want you to click on Formulas on the left side as I've just done. And now you should have a screen that looks identical to what I have on the screen here. The first thing I want to do, now regardless of whether you're in 2003 or 2007, I want you to make sure that the box next to Enable Iterative Calculation is checked. Iterative calculation means calculate something over and over. It allows for circular references to exist in an Excel model without creating an error message. So check that box, and in the maximum iterations box, I want you to put some high number, usually 500 or 1,000. That is, it tells Excel how many times to calculate that loop every time until it finds a solution that solves all the equations. I like to use 1,000. You can use 500. It's really up to you. The next thing I want to do, once we've got the iterative calculation box checked, I want to set up Excel so it only calculates when I tell it to. That is, I want to run in manual calculation mode. Okay, so under Calculation Options, I want you to check the box or highlight the little area that says Manual. And I also want you to check the box where it says Recalculate Workbook before saving. What this means, again, is that Excel is only going to calculate formulas when I tell it to do so. In a lot of cases, if you're running in automatic calculation mode, Excel will calculate every formula in a worksheet every time you step off a cell or every time you hit the Enter button. We don't want that when we model, because if we make an error, if we make a mistake, because this is an iterative loop, a lot of times those error messages will filter all the way through our model, and it will make it very difficult for us to undo them. All right, you might get errors like pound div 0 or pound ref or pound value. All right, again, once those error messages filter through our model, it can be really tough to undo those. Running in manual calculation mode allows us an opportunity to avoid making